Most traders think profitability starts with finding the perfect strategy. They spend months searching for the best indicator, the best entry model, the best mentor, or the secret setup that wins almost every trade. But after all that searching, many of them still lose money. Not because their strategy is terrible, not because the market is manipulated, not because they aren't intelligent. They lose because they never developed the mindset of a professional. The truth is simple. A professional trader and an emotional trader can use exactly the same strategy on exactly the same chart, yet one walks away with consistent profits while the other blows the account. The difference isn't the strategy, it's the habits behind every decision. Trading is one of the few professions where your biggest opponent isn't another person, it's your own mind. Every day the market tests your patience. It tests your discipline. It tests your confidence. It tests your emotions. If your habits are weak, the market will expose them. If your habits are strong, the market will reward them over time. That's why today's video isn't about indicators. It isn't about smart money concepts. It isn't about supply and demand. It isn't about finding the next winning setup. This video is about becoming the kind of trader who can stay profitable regardless of the strategy they use. These are the habits that separate pro from gamblers. Some of them sound simple, but don't confuse simple with easy. The simplest habits are often the hardest to practice consistently. As you watch this video, don't just ask yourself whether you know these habits. Ask yourself whether you actually live by them every single trading day. Knowledge never changed an account. Consistent action does. Let's begin. Habit number 1. Professionals wait, gamblers chase. One of the biggest differences between profitable traders and losing traders can be explained in one sentence. Professionals wait, gamblers chase. Think about a lion in the wild. A lion doesn't run after every animal it sees. It watches, it waits, it studies. Then when the opportunity is perfect, it attacks with full commitment. That's exactly how professionals approach the market. They don't wake up needing a trade. They wake up looking for a reason not to trade. If the setup isn't there, they simply wait. Beginners do the opposite. The moment they open the chart, they feel like they must enter something. Every candle becomes an opportunity. Every small movement feels urgent. Every breakout looks real. Before long, they've taken 5 trades that never existed in their trading plan. Here's something many traders don't realize. Patience is a position. Choosing not to trade is still a trading decision. Sometimes the most profitable trade you'll ever make is the one you never entered. The market will always open tomorrow. There will always be another setup. There will always be another opportunity. But your capital is limited. Protecting your capital is more important than chasing every move. Professional traders understand that money is made by waiting for quality, not by increasing quantity. The market rewards selectivity, not activity. If you struggle with overtrading, don't ask yourself, how can I find more trades? Ask yourself, how can I become more selective? That single mindset shift can completely change your results. Habit number 2. Professionals protect their capital before they think about profits. Ask a beginner what they're thinking about before entering a trade. Most will say profit. How much can I make? Can I double this account? What if this trade runs 500 points? Professional traders ask a completely different question. What happens if I'm wrong? That question changes everything. Every trade has 2 possible outcomes. You either make money or you lose money. Beginners become emotionally attached to only one outcome. Professionals prepare for both. Imagine 2 traders. The first trader risks half of their account on one idea because they're convinced it's going to work. The second trader risks only a small percentage because they know uncertainty is part of trading. The market moves against both of them. One trader is emotionally destroyed. The other simply logs the loss, reviews it, and prepares for the next opportunity. Same market, different habits. Professionals understand something that many traders ignore. You don't need every trade to win. You only need to survive long enough for your edge to play out over a series of trades. Trading is a probability game. No setup wins every time. No strategy has a 100% win rate. The goal isn't to avoid losses. The goal is to make sure no single loss can destroy your future. Think about that carefully. Every time you risk too much because you're sure, you're assuming the market owes you something. It doesn't. The market doesn't know you. It doesn't care about your confidence. It only responds to supply and demand. Protect your capital first. Profits come later. Habit number 3, professionals follow their plan even when their emotions disagree. This habit sounds easy. It's not. Anyone can follow a trading plan after 3 winning trades. The real test comes after a painful loss, or after missing a huge move, or after watching someone else make money while you're sitting on your hands. That's when emotions become louder than discipline. Let's imagine this situation. You've been waiting all morning. Finally, price starts moving. You feel pressure building inside you. What if this is the move of the day? What if I miss it? Without confirmation, without following your rules, you click buy. A few minutes later, price reverses. Now you're frustrated. Not because you lost, but because you broke your own rules. That feeling is worse than the financial loss. Because deep down, you know you weren't trading your system. You were trading your emotions. Professional traders don't eliminate emotions. They simply refuse to let emotions become the decision maker. Fear will always exist. Greed will always exist. Excitement will always exist. The goal isn't emotional perfection. The goal is emotional control. Think of your trading plan like the GPS in your car. Imagine driving to a destination. Halfway through the journey, you decide to ignore the GPS because another road looks faster. You might get lucky, or you might get completely lost. Trading works the same way. Every time you ignore your plan because of emotions, you're choosing uncertainty over consistency. Professionals trust the process, even when the outcome of a single trade is disappointing, because they understand that consistency is built over hundreds of trades, not one. If you constantly change your rules based on feelings, you'll never know whether your strategy actually works. You'll only know that your emotions are making the decisions. Before every trade, ask yourself one question. Am I following my trading plan, or am I following my feelings? That one question can save your account more times than you can imagine. These first 3 habits form the foundation of professional trading. Without them, even the best strategy will eventually fail. With them, you give yourself the opportunity to become consistent over time. In the next part, we'll dive deeper into the habits that allow professionals to stay calm under pressure, avoid emotional mistakes, and think differently from the average trader. Part 2. Habits. Now that we've covered the foundation, it's time to talk about something that quietly destroys more trading accounts than bad strategies ever will. Emotions. Most traders believe emotions are the enemy. They're not. Emotions are normal. Every trader feels fear. Every trader feels excitement. Every trader feels disappointment. The difference is that professionals never allow emotions to take control of their decisions. Let's look at the next habit. Habit number 4. Professionals accept losses as a business expense. Imagine you own a supermarket. Every month you pay rent. You pay electricity bills. You pay staff salaries. You don't get angry every time those bills arrive because you know they're part of running the business. Trading works the same way. Losses are business expenses. Yet many traders treat every losing trade as a personal failure. They begin questioning themselves. Maybe I'm not good enough. Maybe my strategy has stopped working. Maybe trading isn't for me. But one losing trade tells you almost nothing. A single trade is just one outcome in a long series of probabilities. Professional traders understand this. They know that even the best strategies experience losing streaks. The goal is not to eliminate losses. The goal is to keep losses small enough that they never threaten your career. Think about a casino. A casino doesn't panic because someone wins a jackpot. Why? Because the casino understands the law of large numbers. Over hundreds and thousands of games, the mathematical edge works in its favor. Professional traders think the same way. They don't judge themselves after one trade. They judge themselves after following their process over many trades. The next time you take a loss, don't immediately ask, "Why did I lose?" Instead ask, "Did I follow my rules?" If the answer is yes, then it was a good trade, even if it lost money. Because a good process can still produce a losing outcome. Because a good process can still produce a losing outcome. And a bad process can occasionally produce a winning trade. Never confuse the two. Your job is to execute your edge consistently. The results will follow over time. Habit number 5. Professionals never trade to get even. This is one of the most dangerous traps in trading. Let's say you lose 2 trades back to back. Immediately, a voice appears in your head. "I just need one big trade to recover everything." That sentence has destroyed countless accounts. Because now you're no longer trading your strategy. You're trading your emotions. You're trying to erase emotional pain instead of following your edge. This is called revenge trading. The market doesn't know you lost money. The market isn't trying to give it back. Every new setup is completely independent of the previous one. Professionals understand this. They never increase risk simply because they had a losing streak. They don't double their lot size out of frustration. They don't force trades because they feel behind. Instead, they slow down. Sometimes they even stop trading for the day, not because they're afraid, but because they respect how emotions can cloud judgment. One of the greatest skills you can develop is knowing when not to trade. If you're angry, don't trade. If you're desperate, don't trade. If you're trying to recover yesterday's loss, definitely don't trade. Remember this. The market offers opportunities every single week, but if you destroy your account today, you won't be around to take them. Protect your future by refusing to chase your past. 6. Pro-review every trade. Most traders finish trading and immediately close their laptop. The day is over. Tomorrow is another day. Pro don't stop there. Their real work begins after the market closes. They review everything. Why did I enter? Did I follow my rules? Was my risk appropriate? Was I patient? Did I let emotions influence my decision? Could I have managed the trade better? Notice something important. They don't only review losing trades. They review winning trades too. Why? Because a profitable trade can still be a bad trade if it broke the rules. Imagine you ignored your trading plan and somehow made money. Most beginners celebrate. Pro become concerned because they know that bad habits rewarded today become expensive mistakes tomorrow. On the other hand, imagine you followed every rule perfectly and still lost. Many beginners become discouraged. Pro become encouraged because they know they're strengthening the habits that create consistency. This is why every serious trader should keep a trading journal. Your journal isn't there to impress anyone. It's there to expose your patterns. After several weeks, you'll begin noticing things you never saw before. Maybe you lose money every time you trade out of boredom. Maybe your best trades always happen during a specific session. Maybe your biggest losses happen when you ignore your stop loss. Your journal becomes a mirror, and mirrors don't lie. The traders who improve the fastest are not always the smartest. They're the ones willing to study themselves honestly. Growth begins the moment you stop blaming the market and start evaluating your own decisions. At the end of every trading day, ask yourself one simple question. What lesson did the market teach me today? Some days the lesson will come with profits. Other days it will come with losses. Both are valuable if you're willing to learn. We've now covered 6 habits that separate pro from emotional traders. Waiting patiently, protecting capital, following a plan, accepting losses, avoiding revenge trading, reviewing every decision. These habits may seem ordinary, but repeated day after day, they create extraordinary results. In the next part, we'll explore habits 7 through 9, where we'll discuss discipline and why pro understand that trading less often can actually make them more money. We've already covered 6 habits that form the foundation of professional trading. Professionals wait. They protect their capital. They follow their plan. They accept losses. They don't revenge trade. And they review their decisions. But there's another level of trading psychology that you need to understand, because avoiding mistakes is only half of the battle. Eventually, you have to develop the confidence and discipline to execute your edge repeatedly, even when the market isn't giving you what you want. That's where the next 3 habits come in. Habit number 7. Professionals don't need to be right. This might be one of the hardest lessons for a trader to accept. You can be completely convinced that the market is going up and still be wrong. You can spend an hour analyzing S100. You can mark your liquidity levels. You can identify your structure. You can find what looks like a perfect setup. You can have every reason in the world to believe price will move in your direction. And the market can still do the opposite. That's trading. The market doesn't owe you confirmation. It doesn't care how much analysis you performed. And it definitely doesn't care how confident you are. One of the biggest psychological problems traders have is the need to prove that their analysis was correct. Once they're in a position, they become emotionally attached to the prediction. Price moves against them. Instead of accepting that the idea may be invalidated, they start looking for reasons to stay in the trade. They move the stop. They widen the invalidation level. They add another position. They tell themselves, price will come back. That's not confidence. That's attachment. A professional trader thinks differently. Their mindset is, I have a thesis. If the market confirms it, I'll participate. If the market invalidates it, I'll exit. That's it. No ego. No argument. No emotional battle with the chart. Your job isn't to predict the market perfectly. Your job is to manage uncertainty. Think about weather forecasting. If the weather forecast says there's an 80% chance of rain, does that mean rain is guaranteed? No, it means rain is more likely based on the available information. Trading is similar. Your setup may give you an edge, but an edge is not certainty. That's why professional traders can take a loss without feeling personally attacked. They understand that being wrong is part of the business. In fact, one of the strongest things you can say as a trader is, I was wrong. I'm out. Not because you're weak, because you're disciplined. The market doesn't reward stubbornness. It rewards adaptability. Habit 8. Professionals don't trade every opportunity. This is where many traders completely misunderstand trading. They believe more trades equal more money. But trading doesn't work like a salary. You aren't paid for the number of times you click buy or sell. You're paid for executing good opportunities. Imagine a professional sniper. They don't fire at every movement they see. They wait for a clear target. They remain patient. They understand that ammunition is limited. Trading capital is the same. Every trade consumes risk. Every position exposes your account to uncertainty. So why waste that risk on mediocre setups? This is why professional traders become selective. They understand the difference between, I can trade this, and I should trade this. Those are 2 completely different statements. Maybe the market has moved into an interesting area. Maybe there's some liquidity. Maybe there's a small structure shift. Maybe you could build an argument for an entry. But if the setup doesn't meet your complete criteria, you don't have to participate. This is one of the hardest things to learn because the market is constantly moving. You see candles moving without you. You see price reaching your target after you stayed out. And your brain immediately says, see, I should have entered. No, you followed your rules. That's a victory. The market reaching your target without you doesn't mean your decision was wrong. You can't measure a good decision by what happened after the decision. You measure it by whether the decision was justified using the information available at the time. That's an extremely important distinction. Because if you start judging every decision based on hindsight, you'll eventually destroy your discipline. You'll start entering trades you shouldn't take simply because you don't want to miss another move. And that's how FOMO begins. Professional traders don't fear missing a trade. They understand something beginners don't. There will always be another setup. You might miss today's move. That's okay. You might miss tomorrow's move. That's okay too. Your goal isn't to capture every move. Your goal is to capture the moves that fit your system. The market is going to move whether you're watching it or not. You don't need to participate in everything. Habit number 9. Professionals have a trading routine. Consistency doesn't come from motivation. It comes from structure. Think about professional athletes. They don't show up on game day and randomly decide how they're going to train. They have routines. They prepare. They review. They practice. They recover. Trading should be approached the same way. A professional trader doesn't simply open the chart and start clicking. There's a process. Before the session begins, they know what they're looking for. They know the important levels. They understand the broader market context. They know where liquidity may be resting. They know what would invalidate their idea. Most importantly, they know what conditions would make them stay out. That last part is extremely important. A trading plan shouldn't only tell you when to enter. It should tell you when to do absolutely nothing. For example, before your session, you might ask, what is the current market structure? Where are the obvious liquidity pools? What levels matter today? What session am I trading? What is my maximum risk? What setup am I waiting for? What confirms the setup? What invalidates the setup? And what conditions will make me completely stand aside? Once you have those answers, your trading becomes much more mechanical. You aren't making every decision from scratch. You're executing a process, and that's what professionals want. They want fewer decisions, because every unnecessary decision creates another opportunity for emotion to interfere. Think about your trading day as a sequence. Preparation, then execution, then review. Not open chart, see candle, get excited, enter, panic, move, stop, close trade, get angry, enter again. That isn't a trading system. That's emotional improvisation. A routine gives your mind boundaries, and boundaries create discipline. Here's a simple example. Before your trading session, you spend 15 to 20 minutes preparing. You mark your key levels. You define your directional scenarios. You identify the liquidity you're watching. You establish your maximum risk. Then you wait. If your setup appears, you execute according to your rules. If it doesn't appear, you don't force anything. After the session, you review the trade. What did you do well? What did you do badly? What will you repeat? What will you change? Then you're done. This may sound boring, and that's exactly the point. Professional trading should become boring. If your trading feels like an emotional roller coaster every single day, something is probably wrong. The goal isn't excitement. The goal is execution. The bigger lesson. Look at these 3 habits together. Pro don't need to be right. Professionals don't trade every opportunity. Professionals follow a routine. Do you see the connection? They're removing ego and randomness from the process. The average trader wakes up and asks, where can I make money today? The professional trader asks, what does my process require me to do today? That difference is massive. One mindset is outcome-focused. The other is process-focused. And the process-focused trader has a major advantage, because they understand something incredibly important. You cannot control the outcome of a trade, but you can control your preparation. You can control your risk. You can control your entry. You can control whether you follow your rules. You can control whether you stop trading when your conditions disappear. You can control how you respond to a loss. And you can control whether you review your performance. That's where your power is. Stop trying to control the market. Control yourself. That is the foundation of professional trading. And we're only halfway through. We've now covered 9 habits. But the next 6 habits are where things get even deeper. Because becoming a professional isn't just about controlling your trading decisions. It's about controlling your relationship with money, your expectations, your time, and your own definition of success. In part 4, we're going to talk about why professionals don't chase quick money, why they understand the power of repetition, and why your ability to do nothing may be one of your greatest trading advantages. Let's continue. We've made it through 9 habits, and by now you should start seeing a pattern. Professional trading isn't really about doing more. It's about removing unnecessary behavior. You remove unnecessary trades. You remove unnecessary risk. You remove emotional decisions. You remove the need to predict everything. You remove the need to be right. And eventually, trading becomes much simpler. But there's another problem that destroys many traders. They want results too quickly. They want to turn a small account into something huge. They want to make money every single day. They want to recover losses immediately. They want to reach their financial goals as fast as possible. And because they want everything immediately, they start making decisions that their trading system never asked them to make. That's what we're going to address with habit number 10. Habit number 10. Professionals don't chase quick money. Let's be honest. One of the biggest reasons people enter trading is money. There's nothing wrong with wanting to make money. The problem starts when making money quickly becomes more important than trading correctly. That's when everything changes. You start increasing your position size because your account isn't growing fast enough. You start taking setups outside your strategy. You start trading during conditions you normally avoid. You start thinking, if I can just make 20% this week, if I can double this account, if I can recover that loss today, and suddenly you're no longer following a trading business model. You're gambling on speed. Professional traders think in a completely different time frame. They understand that their age needs time to work. One trade doesn't make a trader. One profitable week doesn't make a trader. Even one profitable month doesn't prove that someone has mastered the market. Consistency is built through repetition. Imagine a trader who makes a small, controlled return while protecting their capital for months and years. Now compare that with a trader who makes an enormous return in a few days by taking extreme risk. The second trader may look more successful at first. But what happens if that same level of risk continues? Eventually, probability catches up. That's why professionals don't measure success by how fast they can make money. They measure success by how long they can execute their process consistently. There's a major difference. The beginner asks, how much can I make? The professional asks, how consistently can I execute my edge? The beginner wants a breakthrough. The professional wants repeatability. And repeatability is far more valuable. Because if you can repeat a good process, you can build on it. But if your results depend on one massive trade, one lucky streak, or one aggressive position, you don't have a sustainable system. You have an unstable outcome. Remember this, slow progress with controlled risk is still progress. You don't need to become rich tomorrow. You need to become disciplined enough that tomorrow's decisions don't destroy today's progress. Habit number 11. Professionals measure performance by process, not just profit. This is a massive psychological shift. Most traders open their trading account and immediately look at one number, profit. If the number is green, they feel good. If the number is red, they feel terrible. That creates a dangerous emotional relationship with the account balance. Because now your mood depends on the market. You win a trade, you're confident. You lose a trade, you're frustrated. You win again. You think you're a genius. You lose again. You think your strategy is broken. Your emotions are moving with every candle. Professionals don't operate that way. They track the quality of their execution. Imagine you take a trade. You followed your setup perfectly. Your risk was within your rules. Your entry was valid. Your stop was placed according to your plan. Your target was defined. You managed the position exactly as planned. Then the trade loses. Was that a bad trade? Not necessarily. It was a losing outcome. But it may have been an excellent execution. Now imagine another scenario. You see a random breakout. You enter without confirmation. You risk far more than your plan allows. You don't place your stop properly. The trade suddenly moves in your favor. You close it for a huge profit. Was that a good trade? Not necessarily. It was a profitable outcome. But the process was terrible. This distinction is critical. Because if you reward bad behavior simply because it made money, you'll eventually train yourself to repeat that bad behavior. And eventually, probability will punish it. That's why professional traders keep score differently. Instead of asking only, "Did I make money?" they ask, "Did I execute correctly? Did I respect my risk? Did I follow my setup? Did I follow my entry criteria? Did I respect my invalidation? Did I maintain discipline?" Those questions reveal the real quality of your trading. Profit is the result. Process is the cause. And if you want to improve the result, improve the cause. This is also why your trading journal is so important. Your journal shouldn't simply say, "Buy NAS 100, profit," or "Sell NAS 100, loss." That's not enough. Record the reasoning. Record the setup. Record the market conditions. Record your emotional state. Record whether you followed your rules. Then review your trades as a collection. After 20, 30, or 50 trades, patterns begin to appear. Maybe your best trades happen when you wait for confirmation. Maybe your worst trades happen when you enter early. Maybe your biggest losses happen after you've already taken one loss. Maybe you perform better when you trade only one specific session. That information is extremely valuable, because now you're not guessing what your problem is. You're collecting evidence. And professionals make decisions from evidence, not emotion. Habit number 12. Professionals understand that doing nothing is a skill. This might sound strange, but sometimes the hardest thing a trader can do is absolutely nothing. You open your chart. You see price moving. You watch candles form. You see liquidity being taken. You see volatility increasing. Your brain says, "Do something," but your setup isn't there. So what does the professional do? Nothing. They wait. This is where patience becomes more than an idea. It becomes a skill. Think about how difficult it can be to sit in front of a moving market and refuse to participate. The market is constantly creating noise. There's always another candle, another breakout, another pullback, another possible opportunity. If you don't have strict criteria, you can convince yourself that almost anything is a setup. That's why professional traders create conditions that must be met before they participate. It's not, "Price looks good." It's, "These specific conditions are present." That difference protects you from impulse. Let's say your strategy requires several confirmations. Maybe you need price to reach a specific area. Maybe you need liquidity to be taken. Maybe you need a structural shift. Maybe you need a particular entry model. If those conditions aren't present, there is no trade. It doesn't matter how much price is moving. No setup means no trade. This is where many traders struggle. They confuse activity with productivity. But sitting in front of a chart for 6 hours doesn't make you a better trader. Taking 10 trades doesn't make you more professional. Sometimes your best trading day is the day you take 0 trades because the market never gave you your setup. And that's okay. Actually, that's a sign of discipline. Think about a professional photographer. They might spend hours waiting for the right lighting before taking one photograph. Someone watching from the outside might think, "Why aren't they doing anything?" But the waiting is part of the work. The same is true in trading. The waiting is part of the strategy. Your entry is only one part of your trading system. Your ability to stay out is another. And sometimes staying out is the most difficult decision you'll make. The real meaning of professionalism. Being a professional trader doesn't mean you win every day. It doesn't mean you predict every move. It doesn't mean you never feel fear. It doesn't mean you never experience a losing streak. Professionalism means you have rules that remain stable when your emotions aren't. That's the difference. A beginner's behavior changes with the market. A professional's behavior is controlled by their process. When the market is slow, they remain patient. When the market is volatile, they remain disciplined. After a win, they don't become reckless. After a loss, they don't become desperate. After missing a move, they don't chase. And when there is no setup, they don't manufacture one. That is professionalism. And we're now at 12 habits. Only 3 remain. But the final 3 may be the most important because they bring everything together. We're going to talk about the habits that determine whether you can maintain this mindset over the long term. Because knowing what to do is one thing. Continuing to do it when nobody is watching is another. In Part 5, we'll cover the final 3 habits, build everything into one professional trading framework, and finish with a practical challenge you can use to transform your trading routine. Part 5 Habits 13 to 15 plus Final Framework. We've reached the final part. We've already covered 12 habits. We've talked about patience, risk management, following your plan, accepting losses, avoiding revenge trading, reviewing your trades, not needing to be right, being selective, building a routine, not chasing quick money, measuring your process, and understanding that doing nothing can be a professional decision. But there's one final piece. You can know all 12 of those habits and still struggle. Why? Habit number 13. Professionals protect their mental capital, not just their trading capital. When people talk about risk management, they usually talk about money. How much are you risking? Where is your stop? What's your position size? Those things matter. But there's another form of capital that traders rarely talk about. Your mental capital. Your attention. Your focus. Your emotional energy. Your ability to make rational decisions. You can have money in your account and still be mentally bankrupt. Think about what happens after several hours of watching the market. You become tired. You start seeing setups everywhere. Your patience disappears. A small loss suddenly feels much bigger than it really is. You begin forcing decisions. That's mental fatigue. And mental fatigue can lead directly to financial mistakes. This is why professional traders understand when to step away. Sometimes the best decision isn't changing your strategy. It's closing the chart, taking a break, going outside, getting some rest, coming back when your mind is clear. You don't have to trade every hour the market is open. You don't even have to trade every day. Your strategy doesn't become less effective because you didn't participate today. In fact, sometimes staying away protects your ability to perform tomorrow. Think about a boxer. A boxer doesn't train at maximum intensity every minute of every day. Recovery is part of the process. Trading is similar. Rest is part of performance. If you're mentally exhausted, your decision quality will eventually decline. And when decision quality declines, risk increases. So protect your mental capital. Know when you're done. Because knowing what to do isn't the same as consistently doing it. The final 3 habits are about building the discipline to make professional behavior your default behavior. Let's finish this final outro. If you made it all the way to this point, you didn't just watch a trading video. You spent nearly an hour studying the mindset behind professional execution. So here's your challenge. Don't try to change all 15 habits tomorrow. Choose 3. Pick the 3 habits that expose your biggest weaknesses. Write them down. Put them somewhere you can see them before you trade. And for the next 30 trading days, focus on executing those 3 habits consistently. Because your next level probably isn't hiding inside another strategy. It may be hiding inside the discipline you already know you need. If this video gave you something valuable, make sure you like the video, subscribe to the channel, and turn on notifications for more content on trading psychology, discipline, risk management, and becoming a more consistent trader. And leave a comment telling me one habit you're going to work on first. Not because you need to impress anyone, but because putting it into words makes the commitment real. Remember, protect your capital. Trust your process. Control your emotions. Wait for your setup. And most importantly, think like a professional before you expect professional results. I'll see you in the next one.